Welcome everyone to the deep dive. Today we're jumping right into the July 2025 global market briefing. Our mission really is to dig through all this data and, pull out the most important nuggets, the things that actually give you an edge in understanding what's moving the market. So basically, your shortcut to being really well informed without drowning in the detail.
Absolutely. And what strikes you immediately looking at this briefing is this kind of interesting contrast. You've got global markets showing surprising strength, resilience even. A lot of that seems driven by institutional money finally flowing seriously into digital assets. But that's all happening while, traditional monetary policy is shifting and we've got these geopolitical uncertainties bubbling up. It's definitely a complex mix.
It really is. So, for today's deep dive, we're going to focus on, well, two big areas. First, this incredible maturation we're seeing in digital assets, how they're going from this niche thing to something, well, much more mainstream. And then we'll switch gears to that tricky relationship between foreign exchange, trade policy shifts, and, of course, what the central banks are doing. Let's start with digital assets.
Okay, yeah, the scale here is pretty remarkable now. Take Bitcoin. As of July 29th, it's sitting around $118,715. It dipped a bit, sure, but it's holding pretty firm above $117,000. That's after hitting, what was it, $123,400 earlier in the month. And look at the volume, up 18%, over $65 billion. That's significant activity.
Yeah, huge volume. And Ethereum.
SRP. Ethereum's at $3,885, up nicely. XRP is at $3.26, also positive gains weekly. The whole crypto market cap, it's now crossed the $4 trillion mark, $4.01 trillion to be precise.
4 trillion. Wow. Okay, the briefing mentioned something specific about Bitcoin institutional grade resilience. What does that really mean? Beyond just the price holding up, it also talks about strong on-chain support and illiquid supply ratios hitting multi-year highs. For someone listening who follows markets but isn't like deep in the crypto weeds, what's the takeaway there?
Right. Great question. It sounds technical, but it's actually a key indicator. Illiquid supply ratios basically tell us how much Bitcoin is being held long-term, off exchanges, not readily available for trading. When that hits multi-year highs, it means a large chunk of Bitcoin isn't moving. People are holding it. It suggests strong conviction from long-term holders, the hodlers. They're accumulating, not just trading day to day. It points towards, well, less available supply potentially and a stronger belief in the long-term value, a sign of market maturity, really.
Okay, that makes sense. Strong conviction. And that definitely feeds into this whole institutional breakthrough idea. The briefing calls July a watershed moment for that. Combined Bitcoin and Ethereum ETF inflows, $11.2 billion just this month.
It's massive. Yeah, $11.2 billion. And look at the daily flows. On July 28th alone, Bitcoin ETFs netted $157 million. BlackRock's IDIT was the leader there, $147 million just for them. Fidelity's FBTC also saw good inflows. We're talking about total ETF assets under management getting close to $220 billion now. This isn't just hype. It's serious institutional capital finding its way in.
And presumably that's easier now because the regulatory side is, well, less murky. The briefing mentions the Genius Act and the Clarity Act. What do they actually do for these big financial players?
Essentially, they laid down the ground rules. They reduced the compliance headaches and the operational risks. Before these acts, it was kind of the Wild West for traditional finance wanting to get involved. Now there's a clearer framework. That clarity is crucial. And then you see things like BlackRock filing to add staking to its Ethereum trust.
Ah, okay. So not just buying and holding, but actually using the features of the blockchain, like staking.
Exactly. That's the next step, isn't it? It shows institutions want to engage more deeply beyond just passive exposures, moving past pure speculation towards actual integration.
Integration, yeah, and that ties into infrastructure build-out too. The briefing mentions DeFi, decentralized finance. TVL, total value locked, is apparently above $375 billion now. What's the key thing to note about DeFi's growth, especially for Bitcoin?
Well, the overall DeFi growth is impressive, sure. But the really eye-opening number is the growth in Bitcoin DeFi. Its TVL went from around $300 million to over $7.1 billion year over year. That's quite a jump. It means Bitcoin itself is being used as collateral, as a base layer for these more complex financial services like lending and staking, increasingly at an institutional level.
Okay, so Bitcoin's becoming more than just digital gold. It's becoming a functional part of this new financial plumbing.
Yeah.
And how is this changing its relationship with, say, the stock market? The briefing notes a correlation of 0.87 with equities during peak institutional involvement. What does that mean for investors? Is it still that uncorrelated hedge it was once pitched as?
Well, that 0.87 correlation is pretty high. It suggests that, at least during those periods, Bitcoin is moving much more like a traditional risk-on asset. influenced by the same big economic factors, interest rates, growth expectations, general market sentiment that move stocks. So, yeah, the idea of being a completely separate, uncorrelated asset, that's becoming less true as institutions integrate it. Its role in a portfolio might be shifting more towards growth potential within the broader market context rather than pure diversification away from it.
That's a really important shift in perspective. So, based on all this, the maturity, the institutional flow, the change in correlations, what's the strategic advice coming out of the briefing? For Bitcoin, it suggests what, a 5-7% strategic allocation? And maybe buying dips around 113,000 to $115,000, targets up at 135K, 140K.
That's the guidance, yeah. Keep a core holding, maybe add tactically on pullbacks. And for Ethereum, given the potential around staking ETFs, the suggestion is to increase the allocation slightly, maybe to 10% of your digital asset holdings, looking to accumulate around $3,350 to $3,450 with an eye towards maybe $5,000 by year-end. And for DeFi, it's more selective focus on the established compliant protocols, the ones institutions are comfortable with.
Okay, so a pretty positive picture overall for digital assets, driven by this institutional wave. But like you said at the start, this isn't happening in isolation. Let's pivot to those global headwinds. The US dollar index, the DXY, keeps falling. It's below 98 now. What's pushing it down?
It seems to be a mix of things. Lower treasury yields are part of it. Expectations for inflation may be softening a bit. But also, there are growing worries about the U.S. fiscal situation, the debt levels, and this dollar weakness really highlights the diverging paths of central banks. You've got the European Central Bank holding rates steady at 2%, being quite cautious, maybe even a bit hawkish with Lagarde's comments about inflation. Then you have the Bank of Japan sticking to its ultra-easy policy. That difference makes the dollar-yen exchange rate, USD/JPY, particularly sensitive, especially if it goes above 150. Intervention talk starts then.
Right. And layered on top of that, we have this hard deadline on trade tariffs August 1st. The Trump administration is saying no extensions, reciprocal tariffs hitting dozens of countries. Commerce Secretary Lutnick's hard deadline stance feels, well, pretty firm.
It does feel like a more determined stance this time. And the tariffs are significant. We're looking at 15% on goods from the EU and Japan, but up to 50% on stuff from Brazil, for example. The administration projects this will bring in about $171 billion in revenue, which, incidentally, would be the biggest single tax hike since 1993. But the economic models also predict a drag on GDP, maybe -0.3% and potentially hundreds of thousands of job losses. So there's a clear trade-off.
But here's the weird part, isn't it? The S&P 500 keeps hitting new highs. How do you square that? Is the market just ignoring the potential impact, or has it already priced it in somehow? Especially when the briefing says the overall blended tariff rate could top 20%, the highest since 1911. That sounds serious.
It is puzzling. It could be a few things. Maybe markets believe a deal will eventually be struck, or maybe companies have gotten really good at adapting supply chains quickly. Or perhaps the underlying U.S. economy is perceived as strong enough to absorb the hit, at least for now. Historically, markets do react negatively to trade wars initially, but sometimes they recover if the damage isn't as bad as feared or if other factors are positive. But you're right, tariffs at a level not seen in over a century. That's uncharted territory for modern markets. The long-term impact is a huge question mark.
And the uncertainty is definitely global. The Economic Policy Uncertainty Index, it's at its highest level this century, higher than 2008 or COVID.
Yeah, that's what the index shows, record levels of uncertainty. And that's forecast to drag global growth down to maybe 2.3% next year, which is just below that 2.5% level often seen as sort of global recession benchmark. Plus, you've got retaliation brewing. The EU is prepping its own tariffs on about $72 billion of U.S. goods. It's definitely escalating.
So trade wars heating up, global growth slowing, and the Federal Reserve is caught in the middle. They held rates steady at 4.25% to 4.50% just before their meeting. Markets are betting on a rate cut in September, though, about a 68% chance.
That's what the market pricing implies, yeah. Bond yields have been pretty stable, around 4.40%. But the Fed's job is really complicated right now by the inflation picture.
Right, the mixed signals you mentioned.
Exactly. You have the Consumer Price Index, CPI, accelerating in June to 2.7% annually. You can probably see some early tariff effects in there. But then the Producer Price Index, PPI, the cost for businesses, that was actually flat month on month and below expectations year over year at 2.3%. So which inflation gauge do you focus on? Makes it really hard for the Fed. Some members are worried that these tariffs will keep inflation sticky, higher for longer, which argues against cutting rates too soon. They're walking a very fine line.
A real tightrope walk, as the briefing says. Okay, let's try and tie some of this together. How are commodities reacting? Oil seems pretty resilient.
Yeah, oil prices, WTI around 67 hours, Brent near $71 are holding up. That seems mostly driven by supply concerns, the Russia-Ukraine situation potentially impacting supply, plus ongoing EU sanctions. Gold is also strong, over $3,300 an ounce. That's your classic safe haven play kicking in amidst the trade tensions and the weaker dollar.
Hmm.
Industrial metals, though, things like copper, they're feeling a bit more pressure because of those worries about slowing global growth potentially hitting demand.
And where does Bitcoin fit into this cross-asset view now? We talked about its correlation with stocks, but how's it relating to other things?
It's fascinating. Correlations listed are plus 0.49 with the S&P 500, so still quite linked to equities, but also plus 0.22 with gold, suggesting maybe a flight safe haven characteristic creeping in. Plus 0.54 with copper, which is interesting, maybe reflecting some sensitivity to economic growth cycles. And importantly, man is 0.41 with the 10-year U.S. Treasury. So as Treasury prices go up, yields down. Bitcoin tends to go up too, somewhat inversely to yields. It paints a picture of an asset that's, well, still integrating with the traditional risk complex, but maybe developing some unique defensive qualities too. It's not just one thing anymore. Yeah, I think the biggest takeaway from all this is just how intertwined everything is now. You can't really look at digital assets without considering institutional flows, which are influenced by regulation, which is happening alongside these major shifts in trade policy and central banks strategy, all impacting currencies, it's all connected, influencing each other constantly.
Exactly. It's
Okay.
complex, no doubt about it, and volatile. But understanding these connections, these structural shifts, that's where the opportunities lie, isn't it? So maybe the final thought for you, our listener, is this. We're seeing this unique mix, real regulatory progress and institutional money pouring into crypto, happening at the same time as major geopolitical tensions and tricky monetary policy decisions. Given all that, what new ways of investing might emerge? And maybe more importantly, how will you adjust your own strategy for what looks like a fundamentally shifting financial world?